Hey everybody, this is Mitchell Amador. Welcome back to the Immunefi Show. It's great to be here with all of you. Now, today we have something that's a little bit less security focused, but in many ways just as important and structural to the industry, because we have an expert with us on the subject of market making. And that is one of the great dark arts of our industry. Please welcome Matt Jobbe-Duval, who is the CEO and the co-founder of Coinwatch, a very interesting business monitoring and I think providing accountability, perhaps, is the right way to put it, over market making. We're going to cover whatever is interesting on this subject. So everything from early stage price discovery to how AI agents might interact and get involved with this to, of course, most importantly, how market making works and what it is and why it matters in this industry. But before we dive into all that fun stuff, let's talk who's who. Matt, who are you? Tell us. Don't be shy.
Hi, Michelle. Thanks for having me. So Matt Jobbe-Duval, CEO and co-founder of Coinwatch. I'm French. I started my career as a market maker at 21 years old. I started market making palm oil and base metals out of Singapore for Barclays right after the great financial crisis in 2009. Then I moved to New York, where I started to market make oil and oil options for another few years. Total, I was a market maker for 11 years. Then I kind of got bored of just trading and buying and selling, and I thought surely there is more to life than that. And that's when crypto showed up in my life. It was 2018, and Bitcoin was starting to have its first or second moment. Got interested, read the white paper, and thought, okay, this is cool. I have some savings already, so I can quit trading, maybe look at this crypto thing for a while. If it doesn't work out, that's okay. I'll just go back to banking or hedge fund. And if it does, then at least I'll have some fun. And so that's how I got into things. Started off at CoinList as a product manager, completely clueless, by the way. As a trader for 11 years, you're extremely pointless. The only thing you know how to do is buy and sell and price things. Figure out the value of a thing, right? Whether that's a barrel of oil or a kilo of palm oil. So it took me a while to understand that. Oh wow, what's a product? How does a startup work? But it's been now nearly 7 years that I'm in crypto, and I've never looked back. So yeah, that's for the background.
7 years. So then you came in around 2019, is that right? Like
Exactly right.
the ICO bear market. Everything suffering in the pits, nobody being sure if crypto will even come back and be a thing. And you're like, oh yeah, this is the time I'm going to join.
This is the time. Especially, I was living a pretty senior job. I was making really good money in New York as a head of derivatives trading at Barclays Commodities. And I get that offer from CoinList, right? It was a bit of a crapshoot. Like, okay, let's go. And literally, my salary was divided by 8, I think. And my parents were like, "What are you doing? You spent the last 10 years on Wall Street growing up the ranks to be senior, to manage people, and you're leaving to be in that weird startup that does weird things on a blockchain." And so, yeah, it felt like what the fuck moment. But I don't know. I just felt that there was something there. And I just could not bring myself to just settle on just being a trader. It sounded so boring to me. So I wanted to maybe try a business, do something else. So yeah, I didn't really care about the price of Bitcoin. I just wanted to explore.
Do you know about the history of the East India Company, the British East India Company, or the Dutch East India Company, or the Portuguese traders abroad? Do you know anything about those?
You mean just going a little further to explore the world and see if we can trade with the people over there?
Sure.
Something like that.
The story's a little bit like that, right? You're like, sure, you're making money, you've gotten senior in the firm, but it's boring. It's not interesting. Mm-hmm. You start your business, you leave France, and you go to Singapore. And then you're heading out to Wall Street. You've just gone wherever. And then finally you're like, okay, where's the next frontier of finance? It's so boring. Oh, I know. I'll go to the internet finance frontier. You do sound like in another era you would have been in a slightly different profession.
Potentially, yeah, potentially.
Very adventurous. But okay, you get started at CoinList. Makes sense. And by the way, for those guys who don't know, in 2019, CoinList is the marquee token sale platform in the industry. Most famously, they did Filecoin, which was one of the largest token sales ever for about $150 million. Just gobsmacking amount at the time. And they did a number of other very large deals that ended up becoming successful projects down the line as well. So, quite the place to start, starting off big. But that's just one part of the journey. Follow us through. How do you get to today? What's everything that happened between 2019 and this very moment?
So really the genesis story is at CoinList. And at CoinList, I was this trader guy in a corner, right? And they had hired me, to be fair, taking a chance on this trader dude who says he's into crypto and okay, go sit there and see if you can make a product, right? And I was kind of terrified. For 11 years at the bank, they tell you, okay, this is what you trade, this is your mandate, this is the money you got to make, go. And here it's a startup, right? So you figure it out. And at CoinList, exactly as you say, back then we had these huge token sales, right, going through. So it was Filecoin, the very first one that started the company, and then Solana and Cello and Flow and all the ETH killers out of the 2018, 2019. And guess what? All of these mega protocols, all of them without fail wanted to get launched, their token on an exchange. And all of them without fail would be told by either their investors and or the exchanges, hey, you need a market maker. You need to hire a market maker. And so these guys, imagine, right? 7 years ago, they were like, what does that mean? Market makers out there were Jump and GSR. That was it. Mm-hmm. And so they would go to CoinList and say, hey guys, so the token sale, yeah, great. Thanks a lot again for the money. But now we got to hire these people. Do you know what we're supposed to do? And CoinList said something like, well, go talk to the French guy over there. He probably knows because he comes from that world. And so that's how the genesis of what we're going to talk about started. We got Tolly and Raj from Solana and Mick and many others, from Dapper come to see me and say, hey, can you help us negotiate a market making deal? Apparently you know what you're talking about. So I knew a lot about market making, but crypto market making, nothing, right? Or very little. And so that's how I got started. I'm like, look, I'm sure I can help. I'm not going to charge you. This is part of the CoinList thing that we're doing together. So let's go. And so I would receive these term sheets that Jump and GSR would send these companies, and I would be like, oh my God, like you can imagine, right? Coming from the normal world, and then you see these things which basically say, hey, you're going to give us 10% of your tokens with no strike, just give it to us, and we'll provide a few dollars of liquidity. And like, that makes no sense. And so that's how the thing started, right? I started to see these contracts, tell projects, this is crazy. And project would say, well, what do we do? And I'm like, well, let me try and improve this. And so I would get on the phone. And this is the genesis story of Coinwatch, right? And really me realizing that there was a massive problem, and the problem is a crazy gap between the expertise level of a protocol and that of a market maker, but they still have to work together. And I'm like, well, surely there is something to do. And so I did that for about 2 years at CoinList, that and many other businesses that I worked on, the lending desk, some wrap Bitcoin business, anyway, a few things that I explored that were super fun and profitable for the firm also, thankfully. Then I left, I went to Coinbase. It kind of left the whole market making thing behind me. For me, it was just one of the things I did at CoinList. And so I left that behind me, went to Coinbase, started to work on lending, institutional and retail lending. The mandate back then was, we got to steal Block's 5 thunder, right? I'm like, okay, let's go, let's do it. After 2 months on the job, the SEC subpoenas, my job becomes that of a senior PM to that of a guy on the phone with lawyers 12 hours a day, right? It was horrible. I quit right after 6 months. I'm like, I can't do this. I want to build product. I don't want to just do legal strategy, right? That's just not what I'm good at. And then I went to Dapper Labs, which back then was the cool company to work for, right? NFT machine, Top Shot, blah, 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 working on NFT liquidity. Mm-hmm. Super interesting, but basically joined at the peak. And then, the thing was just not doing very well. So after a year and a half, at Dapper, I was like, okay, what's next? Where should I go? A few hedge funds hit me up, a few market makers hit me up to try to hire me. And weirdly, Andreessen comes to me and is like, hey, so we've heard of what you did for Filecoin back in the day and Solana and a few more. We have more portfolio companies that are getting screwed by their market makers on the daily. Could you help them out? And I'm like, well, sure, I could do it on a weekend, like maybe I can just hook it up and, I charge a few $1,000s and I'll see what I can do. And so he introduced me to one company and then another and then another and another. And I'm like, oh my God, like there is actually a real business here. It's not just, just a little hobby that I was doing. There is real demand. And so realizing that, I knew that I was good at negotiating these deals because it's kind of my upbringing, right? Market making markets. But one thing that was very frustrating to me is that once the deal was negotiated, then the deal is signed, the tokens are exchanged, the protocol sends the tokens to the market maker, but what happens then? And so I'm like, I need a tracking solution. I need something that checks the liquidity in the market. I cannot go on CoinGecko and click on plus minus 2%. That's nuts, right? And so I went to one of the co-founders of CoinList and good friend, Brian Tubergen, genius engineer and CTO back then of CoinList, CTO and head of products. And I'm like, Brian, you got to quit and you got to come build CoinWatch with me, this company. You got to and he's like, oh, are you crazy? I'm a co-founder of CoinList. And I'm like, okay, tell you what, just give me 2 charts. Give me 2 charts. I want the depth and I want the trading volume. That's it. Please give me 2 charts on a website and I won't bother you again. So we built the 2 charts. Today we have, I don't know, like 60 plus charts on our platform. But then I'm like, oh, a 3rd one or a 4th one. And as that was going on, I just started to show him the business, etc. And Brian's like, okay, yeah, there is real flesh to the bone. And I managed to convince him to leave what he was doing and come found CoinWatch with me. And yeah, that's the beginning of it all.
Exciting. And you can already see how much skullduggery is going on in this corner of the world, like, sus stuff. But first, okay, let's give context. So and remember, most of the people listening here are protectors of the industry, security researchers, security experts of various kinds. People have done a lot of stuff. They've been around. They've seen most of these protocols. They're users of many of these protocols. But market making is a bit of an unusual world. And it's surprisingly impactful in all of our lives. But we may not understand what it is. So take a step back and explain what exactly is market making and how does it differ in crypto? Like, what makes it special here and different from the traditional environments?
Absolutely. Market making is actually super simple. Market making is the job of making a market in finance means showing a bid and showing an offer. You got to do both. A price at which you buy, a price at which you sell. Right? That's making a market. Now, market making in crypto, in reality, you go on Binance, you go on Coinbase, you go on Kraken, you look at the order book, the bids and the offers, all of them, you can bet that 70 to 80% of what you see is coming from market makers. Mm-hmm. So now you would say, well, why would they do that? Why would they put bids and offers? Don't they just want to either buy or sell? Well, that's the job of the market maker. Providing liquidity means if I show you bids and offers around that mid price, around that fair value price, I allow someone else to trade with me to either buy or sell or both. Right? And by allowing someone to do that, you bring them liquidity. You allow them to get in and out of their position. You make that thing liquid. That's the job of the market maker. Mm-hmm. It's super simple. Now, of course, the better market making job you get, it means the prices are tighter together and have more size to it. Right? So the holy grail of the market making, it's called a choice market, which means I'm showing you a bid, which is the same price as an offer. It's the same thing. For infinite size, right? Then it means that that asset is infinite. You can either buy it or sell it at any size. Mm-hmm. That's like you cannot do better liquidity than that. Of course, it doesn't exist in crypto. Why is crypto so much different than the real world, than traditional finance? In traditional finance, the job of providing liquidity also is coming from market makers, but they are hired by exchanges. And that is a massive difference. So New York Stock Exchange, NASDAQ, Eurex, any exchange that you have in mind when you think, big places where equities is traded or where commodities are traded, exchanges hire market makers. Exchanges give liquidity KPIs to these market makers. And they say, hey, you want to trade Tesla stock, BlackRock? Okay, you got to be $1 million, 10 bips above and 10 bips below mid, and you got to stay online 99.9% of the time. If you breach these KPIs, you're fired, BlackRock. We're not going to see you on a New York Stock Exchange ever again. Now, New York Stock Exchange are market experts. BlackRock are market experts. So they are talking the same language here. Also, NYSE has all the data about BlackRock on what they do on NYSE because they are the exchange. They are the house. They know exactly every trade, every order that BlackRock does. So when NYSE signs a deal with BlackRock, they know everything that they do. In crypto, the exchange is not involved. It's the client, it's the issuer, right? It's the Tesla. It's as if Elon Musk was hiring BlackRock. Elon Musk doesn't know what BlackRock is doing on the exchange. Yeah, he has no clue, neither him nor his employees. So that's what crypto created, right? This really weird relationship where exchanges is not really in the picture. It's only the place where the thing happens, but they're not involved in the conversation. Mm-hmm. And so you have basically a toddler from a financial perspective who's talking to a hedge fund, and the hedge fund is like, come to me. And that's what CoinWatch is solving.
Why does the market work that way? So why didn't exchanges adopt the market making position as they did in TradFi? Why did this relationship get pushed to independent operators?
It's because in TradFi, when you have a thing that trades on NYSE, on NASDAQ, that thing is pretty big. That thing is a stock. That thing has had an IPO, has had a lot of price discovery. There's a lot of trading behind it. In crypto, tomorrow I can launch a token pretty much. It could be on Binance, on Bybit. I'm exaggerating, but more or less. So because it's vastly more illiquid, assets are vastly less liquid in crypto than in TradFi. The job of the market maker is completely different. The market maker trading something illiquid, it has a tendency to lose money. As a result, market maker said, hey, I need a really big incentive. I need a big pile of cash, or I need a really, really good reason to make markets on these things, because it's going to cost me money to make market on these things. And the exchange would be like, well, I don't have money to pay you, dude. I'm getting trading fees. I don't want to pay you all this cash you're talking about. Go talk to the crypto thing that's trying to get launched. They'll give you some tokens. They'll give you something. I don't want to be part of this conversation. I just want people to trade. I just want to collect the trading fees. So it's really because the market itself is a lot more immature that this relationship ended up being established, because someone had to pay and the exchange did not want to pay.
I see. And so do you think that's going to change with time? Like, is the future of crypto markets and exchanges more like this kind of Korean model or the New York Stock Exchange model where market makers have some direct relationship with the exchanges and they're working that way?
If the average liquidity of crypto in general increases dramatically, yes, that model can make sense. So really the point at which it becomes possible is if market making starts to make money. And that is only possible if it's very liquid. Market makers, BlackRock, why does Jump pay for order flow Revolut, right? They market make for Revolut, for Robinhood. Oh, it's because there's a lot of liquidity, right? So they show a price on Robinhood, maybe 5 bips above mid, 5 bips below mid, but they can hedge on NYSE at 1 bip, right? So because of that order flow makes them money because they can be slightly wider. In crypto, we're talking about vastly larger bid offer spreads and much more volatile markets. So market making just bleeds money. So because of that, because the potential for loss is extreme in crypto market making, they also need a vastly larger incentive. So when that potential for loss starts to be smaller and smaller by having the markets way more liquid across the board, then you don't need the incentive. And then the exchange can come in the middle and say, actually, the exchange, I'm going to be hiring market makers to provide liquidity to this place. So the bootstrapping needs to be done by protocols and these deals that we're working on. Once it gets to a really good place, then the exchange can come in and kind of take it from there when the job is done, kind of thing.
Gotcha. Now, you mentioned that when you were seeing the deals coming across your desk, that they were structured in a funny way, that they were, like you said, you have a hedge fund negotiating with a toddler. So help us understand what kinds of deals are getting offered to people and why they're crazy.
I will tell you what the standard deals are, and then we can go into just crazy stories about deals that I saw and I could not believe my eyes. The standard deal is sorry about that. The standard deal is sorry, the phone is ringing on the other side. There we go. The standard deal is again an exchange of incentives, right? So the project wants liquidity from the market maker. The market maker wants to be paid to provide that service. They can get paid in 2 ways. They can get paid in dollars. It's pretty rare, but it happens. Or they can get paid in tokens. Now, typically, market makers, they don't really want to receive tokens as payments because they know that over time, these tokens have a tendency to lose value. What they prefer to get is a loan of token, and that was a genius. Both GSR and Jump say it's their structure. But it's really a genius structure when you think about it. That's the loan plus call option. This is how it works. Instead of saying, hey, give me a million token and as a payment, and the project would be like, whoa, a million token as a payment, man, that's a lot. Especially pre-launch, right? Where the founders think that the price is going to be sky high. Oh, wow, a million token is a lot. No. Here it is. Lend me a million token. At maturity, I'll send you back the million token, or I'll send you back a dollar amount that is predetermined. And so the price, that dollar amount is essentially the option, is the strike of the option in technical terms. So that sounded like a really good deal for projects like, oh, wow, cool. So if my token doesn't do well, I get back the tokens. So I kind of got the market making business thing for free. And if my token does extremely well, I'm getting back dollars. Well, that's annoying because these tokens are now really expensive. But tell you what, if my token goes up, I don't care, right? Because I got a bunch more tokens, so it doesn't matter, right? So win-win in every direction. So very, very smart structure, very simple, very elegant. That's the normal deal. Now that's the loan plus option, which is, I would say, 80, 90% of the market making deal for the majors at least. And then the dollar payment is called the retainer deal. And the dollar payment, it's a funny one. And it's a crazy trade. I mean, if you brought that to an investment bank, they would be like, are you crazy? But this is how it works in crypto. The project deposits tokens with the market maker, deposits cash, usually both. Right? They bring both of them to the market maker, and the market maker say, okay, thank you very much. I'm going to take your assets. I'm going to trade with them. I'm going to market make with them. And using these assets that you deposited with me, it's not a loan, it's a deposit. I'm going to trade. Oh, by the way, you're going to pay me a retainer every month for the service I'm providing. If I make money with these assets, right? So if the pile of dollars grow, I'm taking a cut. Me, market maker, I'm taking a cut, plus the retainer you pay me every month. If I lose money, it's your assets, right? I just return to you whatever is in the thing at the end. And so you're kind of like, so the market maker cannot lose money. And no, they can't. In these deals, they can't lose money, which is kind of absurd. So that's the two family of deals, the retainer deal and the loan plus option deal, which capture, I would say 99% of the market making deals in crypto.
And what is the traditional, I guess, if New York Stock Exchange was booking a market maker, how would that deal be structured for comparison?
Completely different. There might be a loan of Tesla, of some stock, right? A straight loan, right? There might even be an interest on that loan. Generally, I doubt there would even be a loan because BlackRock is big enough to borrow Tesla stock if they need to, and it's pretty cheap to do. And then BlackRock says, okay, every month we have an envelope of, say, $1 million for the Tesla market makers. Now, at the end of every 30-day period, we're going to look at the leaderboard of which market maker traded the most Tesla stock. And not just traded the most, did maker volume, meaning volume that came from their bids and offers that were in the book, not things that they aggressed, so not orders that they took from the book, orders that they added to the book and someone traded with them. So they look at the leaderboard of the best market maker who did the most maker volume. Okay, you traded the most maker. Okay, you get half of the envelope. You're number one. Market maker number two, you get a third of the envelope. Market maker number three, you get a tenth of the envelope, etc., etc. So you really incentivize for market makers to come in size and to be very tight, and also to be part of that competition, to be on that leaderboard. You need to respect some KPIs. So you need to be always at most that deep, that wide. If you get off the book, boom, you're out of the leaderboard. Even if you did a ton of maker volume, you were off for more than 1 minute, 2 minutes, you're out, and see you next month.
That is way better for possibly better compared to what is being done in the industry.
Indeed.
Basically, the way you describe that, it's almost like that. So the market makers came in, they realized there's all these new assets where they need markets to make, the exchanges aren't going to cover it, and the issuers, they can just issue tokens, at will, effectively. And so they have the means to pay and they have the interest and the desire. And then they find out that they need broad distribution. So they want to get on tons of exchanges in order to get exposure to more potential buyers and have more thicker markets and blah, blah, blah. And so they go there and then they realize, oh, there's only a few of us and there's a lot of them. We can construct the sexiest deals we can possibly imagine and foist that onto this industry. And these aren't even finance people to begin with. They're tech people for the most part. And they're not even going to know. And that's basically what happened.
Absolutely right. And that's when I landed in 2019, when I saw the first term sheets and I fell off my chair. Like, what the fuck is going on? So yeah.
Let's emphasize that to people, because I don't think my colleagues truly understand how dastardly this is. You don't have to name names, but what's one of the craziest stories that you've heard about market makers being skullduggery guys?
So I'll tell you a few. One is not a story; it's a term sheet that I read, and so the term sheet is from a very large market maker. And I was reviewing term sheets because we were working on this deal renewal for this client, and he's like, "Okay, so I've got these pre-existing deals, all right? And so can you eyeball them and tell me what you think?" And I'm like, "Sure, okay, send me the term sheets." And like, well, this one is 3 years long, so it's not expiring anytime soon. It's expiring in 2 years, but I'll send you the term sheets anyway. I'm like, okay, cool. The thing was for 3% of their total supply. That's for many, many billion FDV project, 3% of the total supply. Okay, and like, yeah, but we signed it before the launch, so we didn't know it would be so successful, but okay. And I read the term sheet and I'm like, okay, so 3%, great, perfect. And it was 1% a year that unlocked. So it kind of feels like it's 1%, but really when you add the different pages, it's 3%. And then I get to the option part, and it's like, okay, so that market maker at the end, they have the right to buy each percent. They have the right to buy it for $1. And I'm like, surely it's $1 per token, which would be an FDV of a B and change, I think back then. And I read the term sheet again. It's like $1, a symbolic dollar. So it was a loan and a call option, but the strike was so low that of course the market maker was just going to pay $1 to keep the tokens. And so I call up the client and I'm like, you realize you gave 3% of your network to this market maker? And they're like, yeah, we know. And you don't know what they're doing. You have no idea what kind of work they're doing, if they're doing anything at all. No, we don't know. Doesn't that feel kind of off to you? So that was just a what the fuck moment. Hundreds of millions of dollars of P&L for that market maker, right? And this kind of starts to give you an idea why market makers hate Coinwatch, right? Because I've saved so many projects from these mistakes, being like, whoa, don't sign this. That's insane. That was 3-4 years ago, I think. Another one that I see still quite often.
That's crazy. Is it like straight? It's not theft, obviously, because it's contractual, but it's almost straight theft.
It's absurd. It is unfathomable, right? Another one, and this one is kind of, I've never seen the term sheet. It's kind of a rumor in the market, so I don't know if it's true or not. But many people have said that the comp token, when it launched, had lent 5% of their token supply to a very large market maker. Again, there were very few back then when it launched, and the strike was last round valuation. Market makers love to do that back in the day. The strike was last round valuation. So the price at which they can purchase the token was from a year or two ago. And of course, when the token launches, it's way larger than that. Mm-hmm. So again, 5% of your network, insane. We'll talk later maybe about what kind of liquidity you can expect from a market maker. If you lend them $1, how many dollars should you expect to see in the book? Is it a cent, 10 cents, 50 cents, in liquidity? 5% was just absurd. So that's kind of for the worst right now. We've been at it for a while. Now there is a cottage industry of people who negotiate market making deals, who kind of, looked at what we did and replicated that template. So these things don't happen quite as often because there's more information out there. But we still see very regularly term sheets where market maker cannot be fired from a deal. And if the market maker decides to walk away from the deal, they keep everything. They keep the option, they keep the retainer, they keep everything. And it's kind of like, you talk to market makers, right? It's kind of not right? It's just that's steady state. That's the status quo when you don't have a good advisor at the table to say, that's weird. Projects are like, yeah, that sounds fair. So crazy.
How do you deal safely with market makers in crypto? And keep in mind, a bunch of the people that are listening to this show are likely to launch their own protocols in some form or another in the near future. So lots of people who've hunted on Immunefi or worked with us end up going to build interesting projects in the industry because, of course, we have unique expertise here. Now, if they have to go and deal with a market maker, how do they structure this so they don't get screwed? Because it seems like almost every which way you look, you're surrounded by mines and there's no clear path forward.
Right, 100%. Excellent question, right? And if there was a simple answer, it would be out there. But let me give you some guidelines. So. So remember, the relationship with the market maker is super simple, right? The project is going to give them an incentive. There's usually a loan of token because they need token to work, right? To be able to put orders in the book. And against that, give something and they receive liquidity in exchange. Okay, so really the first question before we answer the question, how much is the market maker supposed to be receiving or what the deal to the market maker should look like? Well, what kind of liquidity do you need? If you are going to only launch on Gate and Kraken and Maxi, you don't really need that much liquidity. If you're going to launch on OKX and Bybit and Hyperliquid and Binance, you're going to need more liquidity. So for projects, that question is pretty hard to answer because they have no clue before they launch, right? Once your token is out, now you kind of see, you kind of know what's up, but they don't know. So I would say the first thing that you need to do as someone exploring this question is have a sense, look at a competitor, a token that kind of looks like you, that's on other exchanges, like you hope to be as well. And look at the kind of liquidity that they have. And for that, you can just go on CoinGecko. They have the plus minus 2% metric, and you add that up, right? Okay, add that up, add these numbers up on the exchanges where you think you're going to be listed. Ignore the BingX and the Ascendex and the stuff that the depth is fake and everything's fake, right? Just focus on the real names. You have 7 or 8 exchanges that you can kind of trust. Mm-hmm. I'm going to put DEX to the side for now, but Club's DEX is about the same. So add up these 2% depth. Take that number, multiply it by 4, 5 at most. That number, so let's say the total depth you see that you add up is 150K. Okay, so times 5, 750K. 750K is the loan size that you should make total to your market makers for them to be able to provide 150K of depth. Okay, with that 750K of loan, you should have either an option or a retainer. But 1 to 5 is a ratio that makes sense for small tokens. Let's say sub 50 to 100 mil FDV. For a big token, 1, 2, 3 billion, the multiplier is more going to be like 2. Maybe a little less than 2. 1 to 2. So you lend $1 to the market maker, you should see 50 cents of liquidity in the books, in orders in the books. Right? That's if you're a big token.
Bigger the market makes it cheaper and more cost effective to provide liquidity.
Exactly right. The more places you're listed in, the easier it is to market make. The more liquid, as I said earlier, right? The more liquidity you have, the cheaper it is potentially to market make, or the less risky it is. As a result, they're more comfortable taking a bigger chunk of that loan and putting it in the books. And also the competition is more fierce, right? A market maker who wants to work with a Monad, with a Mega ETH, with a Layer 0, they are going to want to win that deal. And so of course they know that the more liquidity they promise, well, the better chance they have of winning the deal. So with that 1 to 5, 1 to 4 ratio, this is the fair size. So if a market maker comes to you and says, hey, I want 1% of your total token supply as a loan with a cheap option, say, okay, am I getting 25 bips in the books? And you'll see the market maker will demur. Oh, what do you mean? No, you'll get 10K and 15K here. And it's like, well, wait a minute. Why are you promising me liquidity in dollars? But the supply should be in percentage, the loan should be in percentage of supply. No, that's not right. Either we do everything in dollars or everything in tokens, right? So that's the first red flag. Mm-hmm. Are you following? What? So that's something market makers love to do, negotiate things in percentage of supply so that if the token does extremely well, catching, right? Without having any KPI increase because the liquidity promised is sized in dollars and so that doesn't change.
Mm-hmm. Mm-hmm. So if you're, to summarize for our listeners, number one, a liquid token, 1 to 5 ratio. Larger token, billion plus, 1 to 2 ratio. Number 2, either everything has the same unit of account. Huh? Balloons. Either it's all, it's a sign from God. Either everything is in dollars or everything is in tokens. But probably it should just be in dollars because that's what would be the volume KPIs.
Everything in dollars.
Why would you do anything in tokens? You would only ever do it in dollar equivalents.
Mm-hmm. Exactly right.
Okay.
Exactly right. And so, of course, the loan is delivered in tokens, but sized in dollars. That's important, right? Whether you launch at 100 mil, 500 mil FDV, or 5B, the loan in dollar terms is the same. That's what's fair. That's what's right.
I see. And are there any other ways to ensure you don't get shafted on this?
So going back to the 750K example, right? Now our listeners might think, wait a minute, so I'm lending 750K to my market maker, and there is only going to be 150K in the books. Mm-hmm. And remember, that 150K in the books is only going to be in the books if you make sure it's in the books. If you're not verifying, chances are you'll have way less than that. But that's another topic for later. Mm-hmm. Now, you might wonder, or people might wonder, what happens to the other 600K of loan? That's a big chunk of my loan. What's going on? That's where the problem is coming from, right? When you ask me what things can go bad, that's potentially something that can go bad. The market maker might be like, okay, I'm going to take a fifth and put it in the book. The 4/5, I'm going to sell all of it at launch. And that's usually a problem for projects because if you only have done 600K, that's okay. But a lot of projects, because they don't know that rule and they just trust market makers, they lend vastly more tokens. Mm-hmm. And market makers are not idiots. They know that historically 95% of projects are going to be lower in a week or 2 or 3 post-TG than it is at launch. So they sell hard. at launch. And that selling screw things up because projects have spent a lot of time trying to size supply and demand, but then there is this big entity over there, this big hedge fund receiving a massive loan. I mean, way more tokens than anybody in the market, way more than the team, way more than any VC, way more than any community participant, right? Market makers have a much bigger liquid position than anybody, and they're going to go and sell, right? Because that's how they're going to make their money for the entire year.
Mm-hmm. So they make their money on launch day, effectively selling into the market when there's fresh buyers. And then they, you can't monitor them, or it's very difficult to monitor. And they turn, oh, well, I guess, market's selling, how tragic. Meanwhile, they've sold most of their position. They keep some of their tokens. They're going to take that cash. They're going to keep making that book and hitting that KPI so that they deserve that loan. But in reality, they've already sold out most of their position, and, they're earning interest, or they're earning the trading fees, and they're just laughing. Unless presumably you cancel the deal on them and then they have to rebuy. But if you do that on the expected timeline, they'll be prepared, 2 months from the end of contract, they'll buy back their position, and they'll be like, oh yeah, great doing business with you. When effectively, they just dumped on you on day one, hour one.
That is why crucially you got to track. You say you can track. That's exactly the purpose, the raison d'être of Coinwatch. You can check what they're doing, and you can check that they're in the books and that they're providing that promise 150K. And if they're not doing that work, then indeed we use a template agreement. We don't use the market maker legal agreement because I've reviewed too many and I know they're always going to be horrible. So we use our own, and we tell market makers, either you sign this or you don't talk to our clients. And this agreement says, hey, market maker, if you don't provide the KPIs for more than X many days, X many hours, you're fired. And if you're fired, you give back the tokens now, not next year, now, or in 2 days, or whatever the settlement window is. And so that, of course, if they went turbo short, you're going to feel it because they have to buy back everything. So the market will react in the other direction. And they know in general that doing something like that when a counterparty like us is tracking is extremely bad for their brand, because it's not just you just screwed with a project. It's you're screwed with Coinwatch, and we have 70 projects that we track on any given day. We have more projects coming to ask us for advice, et cetera, et cetera. So the potential brand impact is severe enough that they know it's just either they're going to have to do it very, very stealth, or it's just not a good idea to do it at all.
Mm-hmm. 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 And I imagine, I guess this is kind of like the origin story of your business, of Coinwatch coming together to kind of operationalize this and be like, how am I going to prevent a lot of people from getting screwed at scale and turning this into something?
So yeah, exactly. The origin story is negotiating better deals. And I mean, the bar was so low, right? Like just having something that said, okay, yeah, not 5%, 50 bips, of supply. So that's kind of where it started, and just options that make more sense. So instead of having that conversion price decided as of last year's fundraise, no, let's use the price at launch, which is a real market price, right? So these are the things, just very simple, but that we kind of pushed and are now industry standards. But my frustration was, hey, I'm not tracking anything. I'm not verifying if the deal is actually being met. And this problem lasted for a while. We only found a great solution last year. And Coinwatch is 3.5 years old. For a simple reason, the only way you can track market makers is if you get their API keys. Right? That's the source of truth. That's the holy grail. Anything else is just slop, right? So our competitors in the market making, negotiation and tracking business, what they do is they tell market makers, okay, every day you send us a CSV that tells us the amount of trading you did, the amount of depth that you provided, and if you met your KPIs or not. Simple, right? So I'm a market maker. I'm like, today I did great. Thank you very much. That's it. So that's just BS. And so for a long time, we had this self-reported thing as well, but it was extremely frustrating to me because I'm like, what am I doing? Like the liquidity was just, we could observe empirically the global liquidity. So what's the total depth from Binance? But I didn't know if it was coming from market maker 1, 2, or 3. Or none of them. And so the crazy situation we were in is that, okay, let's say Binance, the KPI was supposed to be 300K deep, but it was only 200K deep. And I would go to market maker 1 and say, hey guys, you're not providing your KPI here. Yeah, I am. It's market maker 2 and 3 that are not. And so every market maker would say, no, I'm the whole market. It's the other guys that are not working. And we couldn't know the truth. And so a year ago, we stumbled upon this thing called the trusted execution environment. This piece of technology that has allowed us to get access to market maker API key information without knowing the API key itself, which was the main unlock. Market makers cannot give API key to anybody external because if you have the actual key, you can just see all of the trading, all of the P&L, all of the inventory. They didn't want to do that. So we built this black box in between the API key and CoinWatch that allows us to sanitize the data and to get rid of the sensitive things that, frankly, we care less about, like their P&L. I don't need to know their live P&L, but I want to know the trading volume that they did, what kind of orders they have in the books, bids or offers, what kind of bid offer spread they're streaming. And so now we are the only company out there that has live real-time feed from 25 market makers that show us in real time what's going on in these order books for our clients. A huge unlock for the industry.
Yes, that would be amazing. I've tried to check in on this, and that is like, I didn't know that you guys had cracked that problem. But how did you get the market makers to agree to that? Because
exactly,
they just want to walk away from these deals. They don't want to be monitored.
Exactly. My co-founder always makes the joke that there must be a hate on me because since I've been working in this industry, I've cost the market making industry in crypto a serious amount of money, not just from educating clients and preventing them from doing things that are just crazy, but also making these deals way smaller. And now we got access to these API keys. How? For the longest time, market makers are like, are you crazy, dude? Like, you're already negotiating deals that are way smaller than what we used to have back in the good days. And now you want us to show you that data? I don't care if you see the API key or not. I don't want you to show my data. Like, why would I want that? For the last 6 years, I've been evolving. Nobody bothers me. I do whatever I want. Clients don't know, right? Maybe I give the client my self-reported data on my own website. I control what's going on. I control what data is being showed. Oh, sorry, today the data is bad. Oh, we had a bug. Oops. So how did we do it? We did it thanks to our clients, right? Our clients include, we've worked with the likes of Optimism, Layer Zero, Monad, recently Sentient. We worked with Starknet and ZK Sync and Morpho and Magic Eden and so many more, right? I think I've negotiated deals for north of 80 clients, and add to that Solana and Flow and Cello back in the day before CoinWatch existed, of course. Mm-hmm. But with all these clients, we basically reached, and it took us 3 years, right? 3 years of existence. API key tracking has only been live for less than a year now, 9 months. It took us 3 years of being instrument and really big part of the market making negotiation, that we told market maker, hey, either you integrate to this tracking solution that is going to respect your privacy, but we will see that data, or you stop seeing the Monads of the world, the Layer Zeros of the world, the Optimism, the WorldCoin of the world. You will stop seeing their business. They will not want to work with you anymore. Mm-hmm. And so that represented enough of a piece of the big market makers' business that they said, okay, fine, let's do it. If it's either that or I lose through 30-40% of my deal flow, I got to do it. And so that's how we managed to do it. And that's why no other firm so far has managed to find the leverage and to have that enough weight to convince them, because quite frankly, it's an annoyance for them. And so they need to have a very good business reason to do it.
I see. And how many market makers, like if you were to, how many firms have agreed to those terms to restructure?
25.
Restructuring the market making market effectively.
For sure. 25 of them are now integrated and live, meaning if any of our clients has a deal or is planning to sign a deal with any of these 25 names, pretty much in the span of 10 minutes, the market maker just has to authorize these. Okay, I agree to show that data, that trading pair on that exchange, on that sub-account. Boom. Then the data is packed directly from the exchange to CoinWatch. And it's near instant. And that's brilliant. We have 2 market makers who refuse to be on the system still. We have a long wait list of market makers who want to be on it, but we're just not prioritizing because they're too small. We've got most of the industry now, from Flow Traders to AMC to Galaxy to Keyrock and Flow Traders and Flowdesk and GSR, and I could go on. The 2 main ones that refuse to get on is Wintermute and Jump.
Mm-hmm. Well, it makes sense that they would both refuse.
Well, everybody will extract the conclusions that they think is the more logical.
Okay, that's not our business to get into why that's the case. Okay, putting that aside, one thing I wanted to make sure I covered was price discovery. And then, I mean, I had a bunch of other questions. We didn't get around to most of them. That's okay. It's been quite the little adventure here. But I want to talk about price discovery. So we talked about how market makers can open, how the loan model is most common, how that can lead to direct selling. But we didn't actually talk about how price discovery works and opens. And for most people who are going to be creating a token or a protocol or a tokenized company in the future, this is actually something they work on a ton. I spent months preparing for the launch of the Immu token for Immunefi, for example. and trying to massage that and plan that and making sure that was going to go in the right direction. Explain to us how that works. Explain to us why it's harder than I think traditional launches in some markets would be, and the role the market maker has to play or not play in it. And it's okay if we cover some of the same ground as before, but I want to give people the full picture because this is a dark art. I had to go through like 40 different conversations before I felt like I had a strong enough picture of what was going on. And by then I already had some contracts to the door, some of which served me well and some of which definitely didn't, right? As it goes. So walk us through, save us all from ourselves.
Perfect. All right. Let me paint a simple picture, because price discovery at the end of the day is something rather simple. It's buyers and sellers who meet and agree on a price to exchange that thing, right? So and the price discovery process exists in any market in the world. In TradFi, the price discovery process is a pretty organized thing that has been regulated for 7 years or so, right? That's the SEC, the reason it existed in the first place. How does it work? Let's say Airbnb IPOs tomorrow. Airbnb, a few months before IPO, they know that, okay, the IPO process means there's going to be a lot of sellers, Airbnb people, employees, founders, funds that have invested in Airbnb that want to sell their position, et cetera, et cetera, et cetera. And then you have buyers, right? You have, of course, retail, right? You also have mutual funds who know Airbnb is going to be in the S&P 500, so they're in line to add it to their ETF, to their vehicle, to their SPV, no matter what. So there is this broad populations that banks know, right? So you have the Harvard Endowment Fund, and you have the mutual funds over there. And, bankers in the middle know, okay, these are the pool of buyers, these are the pool of sellers. And for months before the IPO, the bankers literally are going to fly around the world, right, and meet the mutual funds and meet the Airbnb founders and meet everybody who's going to be part of that price discovery process and say, okay, what price are you keen to buy or sell Airbnb at? And they're going to build literally an order book on paper, on an Excel spreadsheet, and say, okay, so yeah, CalPERS, they're going to buy $100 million of Airbnb if it's at $25 or below. The Brian Chelsky will sell 50 million of Airbnb if it's at $30 or above, like, et cetera, et cetera. And so they have this order book that's built up on basically a spreadsheet. And then they're going to try and find a price that's going to connect something, right? Not too high a price that buyers don't want to participate, not too low that sellers don't want to participate, something in the middle that clears as much trading volume as possible. Now check it out. When that price is actually discovered, that's off market. The market is not on. There is no screen, nothing's blinking, right? It's literally bankers with a spreadsheet that find the price that's going to make the most people happy. Buyers and sellers. Now, at that IPO price, which is the price at the first tick where Airbnb is going to open, there has been billions of dollars of IPO stock that has been exchanged at that price before Airbnb even lists. Right? At the moment Airbnb arrives on NYSE at like 9 a.m. or 9:30 a.m. in New York, $1 billion of Airbnb stock has traded at that price. So it's a very representative price.
It's coming from the roadshow, right? That traveling.
The roadshow. Exactly right.
Committing, right, to buying or selling at that price as well. And so like the orders are already placed, even though no market's open. Mm-hmm. Is that a correct understanding?
Exactly right. Exactly right. These buyers have said months before, I'm willing to buy at that price. The sellers have also said that. And so the price is discovered, and on the day it opens, everything has been done. But that price that is on the screen is very representative. It represents the will and desire of thousands and thousands of buyers and sellers, representing millions of buyers and sellers, right? The people who own the mutual fund, the 401ks in the US, et cetera, et cetera. So there's been a lot of smart people in rooms discussing that price and agreeing on a price that is quite representative of the value of Airbnb based on their dividends and their revenues, et cetera, et cetera. Okay, so when it starts to trade after that, at 9:01, right? The next tick, well, that's okay. Now you, me, anybody can participate, right? We maybe did not get to participate at the IPO price because we're not big and famous, but we get to participate after. But the price is there. So my point is the wave of buyers who everybody wants to buy Airbnb because it's such a cool company has been cleared with literally no volatility whatsoever at that exact price. Now, okay, remember that. Take it to crypto, right? Crypto, let's say let's say Mega ETH, let's say Monad actually, because Monad is real, Mega ETH hasn't launched yet. Monad, I mean, we've been talking about Monad for years, right? Monad is a very famous protocol, blah, blah, blah. Okay, Monad, so they did a token sale on CoinList. Let's say they did not do that token sale, because it's actually an example of a good way to do it. Let's say they did not do it, right? So they did it like another protocol would do, or it's kind of like, okay, boom, let's go. it's exactly that, right? So how does it work? You go on Binance, you want to buy, I don't know, the next hot token, let's say Tether tomorrow tokenizes their equity stock and they launch it on Binance, right? So how does the Binance listing work? I'm sure you've seen some. You see, you have the timer on the screen, right? 5, 4, 3, 2, 1, boom. Okay, that's how it works. During these 5 seconds or 5 minutes or 5 days before, nothing is going on, right? So again, same exact thing. You have buyers and sellers. The buyers are like, oh, okay, they've been on Twitter for months, reading about the thing. They really want to buy it. And the sellers usually are going to be airdrop recipients, community participants, maybe token sale participants, but far and few. Not only that, but their tokens, first they need to claim. Usually the claim happens at or about the same time as Binance. Then the claim, it needs to be moved to Binance. Binance needs to credit it. It's going to take a while because many people are trying to do the same thing. My point is that you've got these two big forces that in TradFi are very much, it's in a quiet environment. The market is not open. The two big buyers and sellers, the two big pools meet in a quiet room and can discuss and can take their time. In crypto, no. In crypto, you got a huge wave of buyer because the buyers, they can buy from the first millisecond because you only need cash to buy, right? So you always have cash on Binance, so you can buy. And the sellers, they come a slow trickle because Binance is going to credit these wallets and the claims are going to come in slowly. And so my point is this big wave of buying, that's what creates the super sky high valuation in the first few hours as the buyers are the only that are represented in the market. The sellers come in later, and that's what brings things lower, right? So now you might ask me, but Matt, buyers cannot buy if there is no sellers. And that's where market makers come in. And that's where people point the finger at market makers because market makers are the only participant on Binance and other exchanges who have tokens before the TGE, the only ones. Right? The projects, and again, I've been in the middle of 150 plus launches. Projects send tokens to the market makers a few hours, a few days before the launch, and that's normal. That's fine. They need to be in the market to make markets. But the market makers, remember from a few minutes ago, and you say, what is their incentive? Well, to sell. That's exactly when it happens, right? They know buyers are crazy. They know buyers are going to buy at market, and so market makers put super high offers, thinking, if I don't get hit, it's fine. I don't sell anything. If I do get lifted, so if someone buys from my offer, great. I sold at sky high valuation, perfect. Nobody's forcing buyers to buy from the market makers. People could be like, whoa, 10 billion value, that's a bit high. I shouldn't buy at that price. But people don't think, right? So buyers still buy. And the market makers like, oopsie, I showed a high offer, someone filled me. Sue me, the market maker is not responsible for sending the price higher. It's certainly the buyer who's responsible for agreeing to buy at that price. But the market maker have a bit of a responsibility. So now you may think, well, market makers should sell lower. Yeah, but why? They're a hedge fund. They're here to make money. What's their incentive to sell lower, right? And so that's kind of where, again, you go back. For me, the process is broken because the price discovery is broken. Because these two massive waves of buyers and sellers, it should not happen when it lists. It should happen before in an organized environment. But yeah, we can talk about that some more if you want.
Well, I think I would like to talk about more about this. But I think we've also probably hit time. If we keep
going,
you're
gonna have to edit a bunch of stuff. You're gonna have to edit me out.
Right, and this is really interesting. I'd be especially curious to hear your views on restructuring the market. So, I mean, if you know about the history of Immunefi, you know that we had a similarly ill-structured market. And we had to reimagine how bug bounties work in order to make them effective and therefore drive security outcomes. Otherwise, people wouldn't do them. And that took multiple years, but it also created a business out of nothing. And it created an industry out of nothing. And it created phenomenal outcomes, ultimately, for the industry in terms of safeguarding it and keeping it legitimate and preventing many, many tens of billions of dollars in hacks. And so I know how valuable that is. And when I hear how you're thinking about this and what you're doing, I'm like, oh, he's restructuring the market. He's putting it on a new foundation. And once you get that itch, right, you've done it once. I've done it a few times in my career. You kind of never want to do other things again because you're like, wow, I can be like maximally creative by remolding this entire environment in my image of what I think it should be like. And you tend to have a bit of virtue ethics that get involved. Like part of it is the glory of doing something so immensely creative, even if it's not just a company, right? It's more interesting than that to kind of change how things work and leave a mark. And so from the way you're talking about it, I can already imagine that you have an idea of how to restructure the launch process or some other similar things here. And probably a number of different areas how you think the crypto markets should change and transform themselves in order to mature until the next stage of development. Is that a good guess?
You read me well. And yes, for sure. I mean, look, it's so frustrating, right? To see not only spend time on a deal and then see a price that is sky high, which is going to screw the market making deal as well, because now the option is super high and the market maker might throw the towel saying, this thing is crazy. I mean, come on, my strike is at $10, the token is at 5 cents. That makes no sense. I'm exaggerating, but you know what I mean.
Sure.
So this can be fixed. And look, like many things in crypto, people start to invent the wheel. Finance has existed for hundreds of years, right? IPOs have existed for 7 years. A lot of humans, very smart, generations over generations, have spent time trying to optimize this thing. So there is a lot that we can do, because right now we're not doing anything. And why? That's really the problem, and the reason why I'm still anxious to work on this problem. As in, I know I want to do it because, as you say, right, like this is such an incredible thing to work on and to leave a mark for the better, right? That's what feels good about when we work on things like that. But it's because the incentives are kind of screwed when you think about it. Everybody around the table want this to stay that way, except retail, and retail doesn't have a seat at the table. So let me take you through super high level. The foundations could come, the protocols, sorry, the projects, they could be part of the price discovery process, just like Airbnb is. Airbnb sells stocks, right, when they IPO. The foundations typically don't really sell at launch. They sell a little before on the token sale, but at launch, around launch, not really. Why? When we tell projects, hey, it would be a good idea to sell at a low valuation so that you make sure that things don't go crazy. These insane buyers, they're going to buy at a cheaper price as a result of you being in the books. The foundation are like, but I want to sell expensive. I've been working for 3-4 years. I want to sell my token expensive. I don't want to sell cheap. Okay, yeah, I get it. It takes discipline, right? Because you're not going to have like all the mutual, all the investors and such, because they're locked. So it's really on the sell side, apart from market makers, it's going to be the project who has a lot of tokens, nobody else. So they need discipline and they need that long-term thinking. Hey, if my launch price is lower, I have a much better chance at looking good. Look, hyperliquid. Everybody's, drooling over it because it is still higher than launch price. How often does that exist, right? So if you could tell projects, hey, you're setting the stage for a beautiful looking token chart by selling cheaper on day one and letting people buy from you cheaper, and then let the thing rally, let the market be on its own. But they don't want to hear that. They want to sell, they want to see a high price. They want a high FDV, even if it only lasts a few days. And that's a shame, number one. Number two, exchanges. There's way more trading volume when things are crazy, right? When nobody can hear themselves in the room, the noise is up, right? If you were like for a few months, okay, let's discover the price, blah, 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 okay, great, let's shake hands. No, they don't want that. They want craziness. So they'll say, yeah, it's more democratic, but it's not democratic. It's not democratic when people buy something at $10 and the next day it's at $2, right? These people get screwed. So exchanges want to keep the thing crazy. Now, I want to carve out a few names like OKX and Coinbase who are trying to have somewhat of a price discovery by having an auction period before the launch. So they say, instead of just turning on the screens at 9 a.m. and letting people trade, we're going to let people place bids and offers for an hour, right? And so we're not going to show the order book, we're not going to show the clearing price, but we're going to let people do that. And that's going to create some price discoveries. It's going to clear some buyers and sellers, because the clearing price, the opening price, is going to be the price at which the most buyers and sellers are trading. That's good. It goes in the right direction. It shouldn't be an hour. It should be a little longer than that. And finally, market makers, they want the craziness because, as I said, having the opportunity to sell tokens as high as possible is where they're going to make most of their P&L for the rest of that market making deal.
Interesting. Gives me a lot to think about, Matt.
I feel like now you have an idea.
I do have some ideas. I wouldn't know if they're good yet, but we can save them for another chat. I would love to have another chat where we dive in more on how you think things should be restructured and what businesses, what opportunities will emerge. For context, we're seeing this right now, right? I mean, I have more of the security lens. We're just seeing the Korean exchanges get blasted by Korean regulators with brutal fines if they don't pay attention to their security postures that are more punishing in many cases than the potential breaches of the fines, which is exactly the correct kind of thing to do in order to enforce higher security standards on the exchanges, which is exactly the kind of thing to do in order to enforce downstream security standards on the projects, because the central point of leverage for security standards for most protocols, it lives oddly enough with exchanges for the same reasons that you've talked about. They are the primary points of listings that every team wants to go to. And so we're seeing them, coming in, right? Also, Korean exchange is known for providing some of the best liquidity in the industry, lots of retail volume. Most market makers not allowed to participate in this market. It's illegal there. And so there's a lot of reasons why it's desirable. And they're changing up the structure in a way that I think can be very, very material for overall security standards. And what I feel like is that the way that you are thinking about things and your view of the history and how to construct these things means that you're going to see how to restructure some of these incentives in a pretty comprehensive way, that you could have new types of exchanges or new types of launch patterns and new types of a lot of things, I guess, that would really help the industry. Retail needs a champion. In an unexpected twist of fate, you're somewhat doing it by holding the market makers to task.
In some corners, for sure. Yeah. One thing that needs solving and just bringing fairness and transparency. I don't know about you, but it's great to work on something that is right. It feels good. You're moving the industry in a more fair direction, not just because it's my business, it's because this is the right thing to do. Having these deals more fair, tracking the work of market makers. Of course, they should get paid. Of course, they should get money, make money, but not at the expense of everybody else.
Sure, I completely understand. I've been protecting the industry for like 6 years, doing nothing but this each and every day. So a market maker didn't. But jokes aside, any closing comments here before we wrap up? This has been great, Matt. Anything else you want to share with us?
This stuff is quite arcane, right? Liquidity. So many projects get taken advantage of because it's really not simple and there isn't much information out there. So before you sign anything, if it feels fishy, it probably is. If you think that, hey, that doesn't sound fair, will it be more fair if X, Y, and Z? Ask. Always check with more than one market makers. Competition, even if you do it yourself, is always healthy. And a bad market making deal can sink your token and really, really, really hurt. So be careful. This is not just another service provider that you're signing who, is going to doing the thing that the spreadsheet says you have to do before you launch the token. It can really doom your project, especially if you cannot fire them. So please be careful. Make sure you do the right thing.
That has been great. Thanks again, Matt, for joining us. And thanks so much, everybody, for listening in. If you want to learn more about what Matt is up to, go check out Coinwatch. It's a really interesting product, really unique, as you've heard from here. And if you're going to be creating a token anytime soon, you're going to need the support for dealing with market makers. And I really encourage you to understand his product, understand what he does, and see if they can take over some of the burden from you. And finally, on our side, guys, I remind you that we are continuing to do our work to protect the industry, covering almost $200 billion in funds protected today. It's a big mission, but we need more help. If you guys would like to get involved, then please go to Immunefi.foundation and see how you can get involved in further protecting the industry. God willing, between the two of us, we'll cover a lot of ground. Awesome, guys.
Thanks, Mitchell.
Thanks very much. I'll see you later.
Bye-bye.